What's up, traders? If you clicked on this video, chances are you're either struggling to pass a prop firm challenge, or you've passed one only to blow your funded account weeks later. Maybe you've even done this multiple times. And every single time, you tell yourself the same lie. I just need a better strategy. Wrong. I'm about to share with you the one secret that separates the 5% of traders who consistently collect payouts from prop firms from the 95% who keep failing challenges over and over again. And fair warning, this isn't some fancy indicator setup or magical entry technique. This is something far more powerful and far more uncomfortable to face. By the end of this 4-part series, you'll understand exactly why you keep failing, what successful prop traders actually do differently, and most importantly, how to fix it before you waste another dollar on challenge fees. But first, let me tell you a story that might sound painfully familiar. Picture this. It's 2 a.m. You're staring at your trading screen, and your stomach is in knots. Your prop firm account that was up 8% just 3 days ago is now sitting at a 6% drawdown. You're dangerously close to violating the maximum loss rule, and you know it. But instead of closing your laptop and walking away, what do? You open another trade. This one will fix everything, you tell yourself. I can see it clear as day. This is the setup. I'll make it all back and then some. 15 minutes later, your account is locked. Challenge failed. Again, you sit there in the dark, and that familiar feeling washes over you. Frustration, disappointment, and that nagging question. What the hell is wrong with me? Here's what nobody tells you. Nothing is wrong with you. You're not a bad trader. You're not unlucky. You don't need a better strategy. You're simply fighting a battle you were never trained for. And it's happening between your ears, not on your charts. Let me hit you with some statistics that the prop firm industry doesn't advertise. Studies and trader experiences show that approximately 80 to 90% of traders fail their prop firm challenges on the first attempt. And of the 10 to 20% who do pass, most of them blow their funded accounts within the first 3 months. But here's what's fascinating, and this is where the secret starts to reveal itself. When researchers analyze the trading records of failed accounts versus successful ones, they find something shocking. The failed traders often had better entry signals. They often had more profitable trades. They often had higher win rates. So why did they fail? Because prop firm trading isn't about finding winning trades. It's about surviving the psychological warfare that happens inside your mind every single second you have an open position. Think about it. You can have a strategy with a 70% win rate that's been backtested over 5 years of data. You can have perfect risk-reward ratios. You can know exactly where to place your stop loss and take profit levels. But none of that matters if you move your stop loss when the trade goes against you. You double your position size after a loss to make it back faster. You take revenge trades after hitting your daily loss limit. You overtrade because you're impatient to hit your profit target, or you freeze up and miss valid setups because you're scared of losing. This is the secret that successful prop traders learn, usually after blowing multiple accounts and losing thousands in challenge fees. Here's what prop firms are really testing. They're not testing if you can predict market movements. They're not even primarily testing if you can make profitable trades. What they're actually testing is whether you can follow strict rules under extreme psychological pressure. Think of it this way. Prop firms are like hiring managers, and the challenge is your job interview. They're not looking for the most talented trader in the world. They're looking for someone who can handle their capital without doing something catastrophic. A prop firm would rather fund a trader who makes a consistent 3 to 5% per month with 0 rule violations than a trader who can make 30% in a month but has emotional control issues. Why? Because the second trader is a ticking time bomb who will eventually blow up their account. It's not a matter of if, but when. The challenge rules aren't designed to make you fail. They're designed to filter out traders who can't control themselves. The drawdown limits, the daily loss limits, the profit targets, the minimum trading days, these aren't obstacles. They're psychological stress tests. And most traders fail them not because they're bad at trading, but because they're bad at trading psychology. In 2024 alone, between 80 and 100 prop firms shut down. Traders lost access to their accounts. Payouts were withheld. Funded accounts disappeared overnight. You know what didn't disappear? The traders who had developed genuine psychological discipline. They simply moved to other firms and continued succeeding because they had developed the one skill that actually matters. Meanwhile, traders who relied purely on their strategy found themselves failing challenges all over again at new firms, wondering why their proven system suddenly stopped working. It didn't stop working. They stopped working. Right now, you're at a crossroads. You can continue down the same path, buying new strategies, trying new indicators, looking for that magical edge, and getting the same results. Or you can accept the uncomfortable truth. The edge you're looking for isn't in your charts. It's in your mind. Here's the thing that might sting a little. Every time you failed a challenge, deep down, you probably knew you were about to blow it before it happened. There was that moment. Maybe it was after your second consecutive loss, or when you started calculating how much you needed to make to hit your target, or when you kept checking your account balance every 5 minutes, when you felt it, that tightness in your chest, that voice in your head saying, "Be careful," that feeling that you were about to do something stupid, but you ignored it, and you blew the account. Successful prop traders learn to recognize that feeling and stop. They've trained themselves to walk away in those moments, even when every fiber of their being wants to take just one more trade. That's the secret. It's not complicated. It's not sexy. It's not something you can buy in a $97 course. It's psychological discipline, and it's the only thing standing between you and consistent prop firm payouts. In the next 3 parts of this series, I'm going to break down exactly what this looks like in practice. Part 2 will expose the 5 psychological traps that kill more prop firm accounts than bad strategies ever could. And I'll show you the exact moments these traps activate so you can spot them before they destroy your account. Part 3 will reveal the mental framework that 6-figure prop traders use to make decisions under pressure. This is the system that allows them to follow their rules even when their emotions are screaming at them to break them. Part 4 will give you the step-by-step implementation plan to rebuild your trading psychology from the ground up, including the daily practices, the pre-trade routines, and the emergency protocols that will transform you from an emotional trader into a disciplined one. But here's the catch. This only works if you're willing to be brutally honest with yourself. You can't fix what you won't acknowledge. And most traders aren't ready to admit that their biggest problem isn't their strategy, it's themselves. So let me ask you, are you ready to stop pretending your next strategy will fix everything? Are you ready to face the uncomfortable truth about why you keep failing? If your answer is yes, then stay with me through this series. I promise you, what you're about to learn will be more valuable than any trading course you've ever bought. Because at the end of the day, you can have the best strategy in the world, but if you can't control yourself, you'll never control your trading account. Hit that subscribe button and turn on notifications so you don't miss parts 2, 3, and 4. Trust me, what's coming next might just save your trading career. In part 2, I'm going to walk you through the 5 psychological traps in excruciating detail. I'll show you exactly how they manifest, why they're so deadly, and most importantly, how to defuse them before they destroy your account. See you in the next video. And remember, the market doesn't care about your feelings, but your prop firm account definitely does. Revenge trading. We all know it's bad. So why did you do it again yesterday? Because knowing what to do and actually doing it are 2 completely different games. And in this video, I'm going to show you exactly what's happening in your brain when you self-destruct. Welcome back to part 2. If you watched part 1, you already know the secret. Prop firm success has almost nothing to do with your strategy and everything to do with your psychology. But here's where it gets practical. I'm about to walk you through the 5 psychological traps that kill more funded accounts than bad trades ever could. And here's the kicker. You've fallen into every single one of them. Multiple times. Maybe even this week. I'm not here to make you feel bad about it. I'm here to make you aware of it. Because awareness is the first step toward change. You can't avoid a trap you don't know exists. These aren't abstract concepts. These are specific, identifiable moments where your brain hijacks your trading decisions. And by the end of this video, you'll know exactly what they look like, why they happen, and what to do when you feel them coming. Let's dive in. Trap number 1, the revenge trade. Let's start with the big one. The account killer. The trap that has probably cost you more money than any other single mistake. The revenge trade. Here's how it always starts. You take a loss. Maybe it was a valid setup that just didn't work out. Maybe you got stopped out by a wick. Doesn't matter. What matters is what happens in the next 60 seconds. Your heart rate increases. Your jaw clenches. And this thought enters your mind. I shouldn't have lost that trade. The market is wrong. I need to get that money back right now. And before your rational brain can stop you, you're in another trade. Bigger position size. No plan. Pure emotion. Here's what's actually happening in your brain. When you take a loss, your brain releases cortisol, the stress hormone. This triggers your fight or flight response. Your prefrontal cortex, the part responsible for rational decision-making, literally shuts down. You're not thinking anymore. You're reacting. Studies on trading psychology confirm what experienced traders already know. Approximately 90% of trading success is psychological. The traders who win aren't smarter. They're just better at recognizing when their brain is hijacked, and they have protocols to stop themselves. Here's the revenge trade protocol. Rule 1. After any loss, you must wait at least 15 minutes before taking another trade. No exceptions. Set a timer. Walk away from your screen. Rule 2. After 3 consecutive losses in a single session, you're done for the day. Close your platform. It doesn't matter if you see the perfect setup. Your brain is compromised. Rule 3. Never, ever increase your position size after a loss. If anything, decrease it. The market doesn't care about your feelings, and it's not going to give you back what you lost. But here's the real question. Can you actually follow these rules when your account is down and every cell in your body is screaming at you to make it back? That's what separates profitable traders from the rest. Trap number 2, the correlation stack. This one is sneaky because it looks like diversification, but it's actually just hidden over leverage. Picture this. You see USD strengthening across the board. So you think, perfect. I'll go long on euro to US dollar, pound sterling to US dollar, and Australian dollar to US dollar all at once. 3 trades, 3 profit opportunities. Except they're not 3 trades. They're 1 trade. 1 directional bet. 1 massive risk position. If USD continues strengthening, all 3 positions win. But if USD reverses, all 3 lose. Together. At once. And your 1% risk per trade rule just became a 3% account-killing loss in minutes. Prop firms track this. They call it correlation risk, and it's one of the fastest ways to violate your maximum drawdown limit. Here's the trap. Your brain sees multiple positions and thinks, I'm being careful. I'm spreading my risk. But you're not. You're concentrating your risk while lying to yourself about it. The correlation stack protocol. Rule 1. 1 directional idea equals 1 trade. Period. If you're bullish on USD, pick your highest conviction USD pair and trade that. Not 3 or 4. Rule 2. Your total risk across all open positions should never exceed 2 to 3% of your account. Not per trade, total. Rule 3. If you absolutely must trade correlated pairs, your combined position size should equal what you'd risk on a single trade. So if you normally risk 1% per trade, and you're taking 2 correlated positions, each position should be 0.5%. This trap destroys accounts because traders don't realize they've violated risk management rules until it's too late. You think you're trading smart, but you're actually gambling, and the house always wins eventually. Trap number 3, the silent killers. Spread and slippage. Most traders obsess over their strategy and completely ignore the hidden costs that are slowly bleeding their account to death. Let me show you how insidious this is. You execute a trade on euro to US dollar. The spread is 2 pips. Doesn't seem like much, right? But on a $100,000 account with a 1.0 lot position, those 2 pips cost you $20. Now multiply that by 50 trades in a month. That's $1,000 in spread costs alone. Add in slippage, the difference between the price you expect and the price you actually get filled at, and you're looking at another 0.2 to 0.5% loss per trade. Here's the math that most traders never do. If your strategy has a 2% edge per trade, but you're losing 0.5% to spread and slippage, your actual edge is only 1.5%. And that's before commissions. This matters even more during high-impact news events. The spread can widen to 10 to 20 pips. Slippage can be catastrophic. And many prop firms explicitly forbid trading during major news releases, because they know most traders will get destroyed by these hidden costs. The silent killer protocol. Rule 1. Check the spread before entering every trade. If it's wider than normal, wait. Rule 2. Never trade during major news events. The potential profit isn't worth the risk of massive slippage and spread widening. Most prop firms ban this anyway. Rule 3. Build a spread buffer into your risk calculations. If you normally risk 1% per trade, calculate it as 1.2% to account for spread costs. This forces you to size your positions slightly smaller and gives you a protective cushion. The traders who consistently pass prop firm challenges and maintain funded accounts are the ones who respect these microscopic details. They know that death by 1,000 paper cuts is still death. Trap number 4. The scaling illusion. This trap gets traders who are actually good at their craft. You've passed your challenge. You've got a funded account. You're making consistent profits. The prop firm offers you a scaling plan. Double your capital if you hit certain targets. Your brain goes into overdrive. More capital means more profit. I just need to trade a little more aggressively to hit these targets faster. And that's where it all falls apart. Here's the psychological trap. Scaling opportunities create artificial urgency. You start thinking about the bigger account instead of focusing on your process. You start calculating how much you need to make rather than executing your strategy. And the moment you start managing your trades based on your profit target instead of the market's price action, you've become a gambler. Research on prop firm success consistently shows that traders who focus on process-based goals like follow my plan perfectly on every trade outperform traders who focus on outcome-based goals like make 10% this month. Why? Because you can control your process. You can't control the market's outcome. The scaling illusion protocol. Rule 1. Never change your trading behavior because of a payout opportunity. Trade the exact same way on a $10,000 account as you would on a $200,000 account. Rule 2. After hitting a profit milestone or receiving a payout, take a day off. Let your nervous system reset. The market will still be there tomorrow. Rule 3. Track process metrics, not just profit metrics. Count how many times you followed your rules perfectly. That's your real scorecard. The traders who scale successfully don't trade more. They don't risk more. They just keep doing the same thing that got them funded in the first place, and the profits compound naturally over time. Trap number 5, the perfect setup paralysis. This is the opposite of overtrading, but it's just as deadly. You've taken a few losses. Your account is sitting at a 4% drawdown. You're 1 or 2 bad trades away from violating your maximum loss limit. And then you see a perfect setup. Everything aligns. Your strategy is screaming at you to take this trade. But you don't. You freeze. What if it's a false signal? What if this is the trade that kills my account? Maybe I should wait for an even better setup. And you watch the trade play out perfectly without you. The profit you needed to recover your account just disappeared because you couldn't pull the trigger. This is loss aversion in action. Your brain is wired to avoid losses more strongly than it seeks gains. Psychologically, losing $100 feels about twice as bad as winning $100 feels good. When you're in drawdown, this effect amplifies. Your brain becomes so terrified of further losses that it prevents you from taking any risk at all, even calculated strategic risk. The perfect setup paralysis protocol. Rule 1. If a setup meets 100% of your strategy criteria, you must take it. No exceptions. Trust your system. That's why you backtested it. Rule 2. Pre-commit to your trades. Write down in advance what conditions must be met for you to enter. When those conditions appear, execute automatically without thinking about it. Rule 3. Separate the decision to enter from the outcome of the trade. A good trade that loses is still a good trade. A bad trade that wins is still a bad trade. Judge yourself on execution, not results. Here's the brutal truth. If you can't take valid trades because you're scared, you don't have a trading problem. You have a risk management problem. Your position sizing is too large for your psychological tolerance. If losing one trade feels catastrophic, you're risking too much. Period. Cut your position size in half, even if it means slower progress. Slow progress is better than no progress, and way better than blown accounts. Notice the pattern. Every single one of these traps activates when you stop following your process and start managing your account based on fear or greed. Revenge trading equals greed. Need to make it back. Correlation stacking equals greed. Want more profit opportunities. Ignoring hidden costs equals ignorance, not respecting the small stuff. Scaling illusion equals greed. Want the bigger account faster. Setup paralysis equals fear. Can't afford another loss. The solution to all of them is the same. Return to your process. Trust your system. Execute without emotion. Easier said than done, right? That's exactly what part 3 is about. In the next video, I'm going to give you the exact mental framework that six-figure prop traders use to execute their trades flawlessly, even when their emotions are at their worst. This isn't motivational fluff. This is a systematic approach to decision-making that removes emotion from the equation. It's how professional traders manage $500,000 accounts with the same calm demeanor they had when they managed $10,000. You'll learn the pre-trade checklist that makes revenge trading impossible, the neural reprogramming technique that stops you from breaking your rules, and the emergency shutdown protocol for when you know you're about to self-destruct. Drop a comment right now and tell me which trap you fall into most often. Revenge trading? Correlation stacking? Setup paralysis? Be honest. Nobody here is judging you. We've all been there. See you in part 3. And remember, awareness without action is just entertainment. It's time to actually change. I'm about to show you the same mental framework that a trader used to go from blowing 5 prop firm accounts in 6 months to making consistent 5-figure monthly payouts. And it has nothing to do with a better strategy. In fact, he used the exact same strategy. He just learned how to actually follow it. Welcome back. In part 1, you learned the secret. Psychology beats strategy. In part 2, you identified the 5 psychological traps that keep destroying your accounts. Now comes the part that actually changes your life, the framework. This is the systematic approach that removes emotion from your trading decisions. It's the difference between knowing what to do and actually doing it when your account is down and your stress is up. I call this the decision architecture framework, and it's based on a simple but powerful principle. You can't trust yourself in the moment. Your emotions will hijack your decisions. So you need to make your important decisions before the emotion hits. Think of it like this. When you're calm and rational, before you open any trades, that's when you're your smartest self. That's when you can think clearly and make good decisions. But when you're in a trade that's going against you, or you've just taken 3 losses in a row, or you're 1 trade away from hitting your profit target, that's when you're your dumbest self. Your emotional brain is in control, and it's going to make you do stupid things. The solution isn't to somehow become more disciplined in those heated moments. The solution is to not let those moments happen in the first place. Let me show you exactly how. Pillar number 1, the pre-trade protocol. This is your first line of defense against emotional trading. It's a mandatory checklist you complete before entering any trade, no exceptions. Here's what it looks like. Mental state check. Am I calm and focused, or am I feeling rushed or emotional? Did I sleep at least 6 hours last night? Have I eaten in the past 3 hours? Am I trading to make money, or am I trading to feel something? If you answer poorly to any of these, you don't trade. Period. This might sound trivial, but here's the reality. Studies show that traders make significantly worse decisions when they're tired, hungry, or emotionally activated. Your willpower is a finite resource, and it depletes throughout the day. That's why professional traders trade during specific hours when they're at their mental peak, and completely avoid trading when they're not. Setup validation. Does this setup meet 100% of my strategy criteria? What's my entry price? What's my stop loss price? What's my take profit price? What's my risk to reward ratio on this trade? Here's the rule. If you can't answer all 5 of these questions immediately and confidently, you don't take the trade. Most failed trades happen because traders enter positions they're not actually confident about. They see something that looks pretty good and hope it works out. That's gambling, not trading. Risk assessment. What's my current account balance? What's my current drawdown percentage? How much am I risking on this specific trade in dollars and percentage? What's my total risk across all open positions? How many trades have I taken today? This section prevents correlation stacking and overtrading. If you're at or near your daily trade limit, your total risk limit, or your drawdown danger zone, you don't trade. The critical question: if this trade loses, which is always possible, will I be okay with that outcome? If the answer is no, your position size is too large. Cut it in half. The pre-trade protocol takes about 90 seconds to complete, and those 90 seconds will save you from 90% of your bad trades. But here's the secret: you have to actually do it. Every single time. Before every single trade. No shortcuts. No, just this once. No, I already know the answers. The moment you skip the protocol is the moment you open the door to emotional trading. Pillar number 2, the decision journal. Most traders keep trade journals that focus on the wrong things. They record their entry price, exit price, profit/loss, and maybe some notes about the market. That's fine, but it's incomplete. The decision journal focuses on your psychology and decision-making process, not just the trade outcome. Here's what you record for every trade. Before the trade, time and date. What I'm feeling emotionally, whether calm, anxious, excited, frustrated. Why I'm taking this trade, be specific. What signals did you see? What could go wrong with this trade? My contingency plan if it goes wrong. During the trade, any temptation to move my stop loss or take profit. Any emotional reactions while the trade is open. Any urges to add to the position or exit early. After the trade, did I follow my plan exactly? What did I do well? What did I do poorly? What pattern am I noticing about my behavior? Notice what's missing? The actual profit or loss amount. That's intentional. Your decision journal isn't about whether you made money. It's about whether you followed your process. Because if you follow your process consistently, the profits take care of themselves. Here's what happens when you maintain a decision journal. After 30 to 50 trades, you start seeing patterns. You notice that you always get emotional after 2 consecutive losses. You realize you always overtrade on Friday afternoons. You discover that you trade best in the first 2 hours after market open and terribly during the last hour before close. These insights are worth more than any trading strategy because they're personalized to you. They're your specific weaknesses and strengths. And once you know them, you can design rules to protect yourself. For example, no trading after 2 consecutive losses. No trading after 2 p.m. No trading on Fridays. These aren't random rules. They're based on data, your data. Pillar number 3, the circuit breaker system. This is your emergency shutdown protocol. It activates automatically when you hit specific triggers that indicate you're about to self-destruct. Here are the circuit breakers that should immediately end your trading session. Circuit breaker number 1, 3 strikes rule. After 3 losing trades in a single session, you're done. Close your platform. Walk away. It doesn't matter if you see the perfect setup 5 minutes later. Your brain is compromised. The data is clear. Traders who continue trading after 3 consecutive losses make significantly worse decisions and usually compound their losses. Circuit breaker number 2, daily loss limit hit. If you hit 50% of your maximum daily loss limit, you stop trading immediately. Why 50% and not 100%? Because if you wait until you're at your actual limit, you're one impulse trade away from violating your prop firm rules. You need a buffer zone. Circuit breaker number 3, the emotional trigger. This one is subjective, but it's the most important. If you notice any of the following, you stop immediately. Your heart rate is elevated. You're thinking about how much money you could make or lose. You're checking your account balance every few minutes. You feel an urgent need to place a trade. You're angry at the market or at yourself. You're thinking, I need to make this money back. These are all signs that your emotional brain has taken over. You're no longer trading, you're reacting. The circuit breaker rule is simple. When activated, you close your trading platform and you don't open it again for at least 2 hours. Preferably, not until the next trading session. No exceptions. No, let me just check one more thing. No, I'll just watch, I won't trade. Remove the temptation completely. Pillar number 4, the growth mindset reframe. This is the psychological foundation that supports everything else. Most traders have a fixed mindset about their trading results. When they lose, they think, I'm a bad trader. I can't do this. I'm not cut out for this. When they win, they think, I'm a genius. I've figured it out. I'm unstoppable. Both of these mindsets are toxic. The growth mindset reframe changes how you interpret your trading results. Old mindset. I lost money today. I'm a failure. New mindset. I collected data today about what doesn't work. This loss is part of the cost of my trading education. Old mindset. I made money today. My strategy is perfect. New mindset. I executed my plan well today. I'll continue following my process and let the results take care of themselves. Old mindset. I broke my rules and blew my account. I'm never going to succeed. New mindset. I identified a specific breakdown point in my system. Now I can design a safeguard to prevent this from happening again. This isn't just positive thinking. This is a fundamental shift in how you measure success. In trading, you can't control outcomes. The market will do what it does, but you can control your process. So measure yourself on process, not results. Did you follow your pre-trade protocol? Success. Did you stick to your risk management rules? Success. Did you activate your circuit breaker when you hit 3 losses? Success. The actual profit or loss is just feedback. It's data. It's not a judgment of your worth as a trader or a person. When you internalize this mindset, losses stop devastating you emotionally. They become expected costs of doing business. And wins stop inflating your ego. They become validation that your process is working. This emotional stability is what allows traders to maintain consistency month after month, year after year. Let me show you what this looks like in practice. You wake up on a trading day. Before you even look at the charts, you complete a quick self-assessment. How did you sleep? How are you feeling? Are you mentally ready to trade? If yes, you open your platform. If no, you take the day off. You scan the markets and identify a potential setup. Before entering, you go through your pre-trade protocol, mental state check, setup validation, risk assessment, and the critical question. Everything checks out. You enter the trade. While the trade is open, you notice your heart rate increasing. You feel the urge to check your account balance. You recognize this as an emotional trigger, so you close your platform and walk away. You trust your stop loss and take profit to manage the trade. The trade hits your stop loss. You lost. You immediately write in your decision journal how you felt, what you were thinking, whether you followed your plan. This is your second loss of the day. One more, and your circuit breaker activates. So you're extra careful with your next trade. You see another setup. You go through the pre-trade protocol again. But this time, when you get to the critical question, if this trade loses, will I be okay with that? You realize the answer is no. You're feeling anxious about hitting your daily loss limit. So you either skip the trade entirely, or you cut your position size in half to reduce the psychological pressure. You take the trade with the smaller size. It wins. Even though you made less profit than you could have, you followed your process perfectly. And that's a successful trading day. This is what disciplined trading looks like. It's not exciting. It's not dramatic. It's systematic, boring, and consistent. And that's exactly why it works. The framework I just gave you is the exact system that professional prop traders use to manage 6- and 7-figure accounts without breaking a sweat. But here's the thing. Knowing this framework and implementing it are two different things. That's what part 4 is for. In the final video of this series, I'm going to give you the step-by-step implementation plan. You'll learn exactly how to rebuild your trading psychology from scratch, how to practice these protocols until they become automatic, and how to troubleshoot when you inevitably slip back into old patterns. Because you will slip. Everyone does. The difference between traders who succeed and traders who fail isn't that the successful ones never mess up. It's that they have a system to get back on track quickly when they do. Comment below and tell me, which pillar of this framework resonates with you most? The pre-trade protocol? The decision journal? The circuit breakers? Or the mindset reframe? Let me know in the comments. See you in part 4, where we put all of this into action. If you've made it this far through the series, you're already ahead of 90% of prop firm traders. Most people watch a video, nod their heads, and then go back to making the exact same mistakes. But you're different. You're still here. And in this final part, I'm going to give you the exact step-by-step plan to transform everything you've learned into results. This is the implementation blueprint. No more theory. No more concepts. Just action steps that you can start using today to rebuild your trading psychology from the ground up. And fair warning, this is going to require work. Real work. Not watching more videos or buying more courses. Actual daily practice. Are you ready? Let's do this. Step 1. The 30-day reset period. Before you take another prop firm challenge, you need to hit the reset button. I don't care if you've already paid for a challenge. I don't care if you're eager to get started. If you rush into this without preparation, you're just going to repeat the same patterns and get the same results. Here's what the 30-day reset looks like. For the next 30 days, you're not trading real money or challenge accounts. You're trading a demo account with the exact same rules as your target prop firm. Same drawdown limits. Same daily loss limits. Same profit targets. Same everything. But here's the twist. You're not trying to pass the challenge. You're trying to prove to yourself that you can follow your process perfectly for 30 consecutive trading days. Not 30 profitable days. 30 days of perfect execution. Every single day, you complete your pre-trade protocol before entering any trade. You fill out your decision journal after every trade. You activate your circuit breakers the moment they're triggered. You track your compliance rate. That's your only metric that matters during these 30 days. At the end of each week, you review your decision journal. What patterns are emerging? When do you trade best? When do you make mistakes? What are your specific triggers? This is self-discovery work. This is where you learn who you are as a trader, not who you think you are. And here's the rule. If you violate your rules at any point during the 30 days, you restart the count. Back to day 1. I know that sounds harsh, but this is exactly the discipline you need to develop. If you can't follow your rules on a demo account with zero financial pressure, you will never follow them on a funded account with real money on the line. Step 2. The mental reconditioning protocol. Most traders think trading psychology is something you feel. It isn't. It's something you train. And if you've been struggling, overtrading, revenge trading, breaking rules, blowing challenges, it's because your mind has been conditioned for years to respond to the market in the wrong way. The market triggers you. Your body reacts. Your emotions take over. Your rules collapse. This protocol rewires that. For the next 30 days, you're going to build a new mental operating system, one habit at a time. Here's how it works. Every morning before you trade, you run a 5-minute mental rehearsal. Close your eyes and visualize the exact trader you are becoming. Not the results. Not the profit. The behaviors. See yourself following your rules with zero friction. See yourself watching a setup form and not taking it because it doesn't meet criteria. See yourself hitting your daily loss limit and shutting everything down without a second of hesitation. Your nervous system needs to experience discipline before your trading does. Then, during the trading session, you run what I call the emotional awareness loop. Every time you feel an emotional spike, FOMO, hesitation, anger, excitement, you pause. One breath. One check-in. One question. What state am I trading from right now? This is how you detach from the emotion instead of becoming the emotion. And finally, every evening, you complete a short mental debrief. Not of your trades. Of you. What emotional states did you experience today? When did you feel most grounded? When did you feel most reactive? This is how you begin to identify the deeper patterns that sabotage you long before the losing trade ever happens. This is the work funded traders do. Step 3. The rule reinforcement framework. This is where discipline stops being a hope and becomes a system. Because no matter how motivated you are right now, motivation will fade. Discipline only lasts when it's reinforced. Here's how you build it. You create 3 non-negotiables, your absolute lines in the sand. Break any of these, and you're done for the day. No exceptions. For example, I never exceed my daily loss limit. I never take a trade that isn't written in my plan. I never change my stop loss once the trade is active. These three become your identity rules. Break them, and the session ends immediately. Then you create 3 session standards. These are behaviors that must happen in every session. Run your pre-trade checklist. Journal every trade. End the session with a review. Finally, you create your hard consequences. If you break a rule, you don't punish yourself, you repair the behavior. No trading tomorrow. You redo the mental rehearsal. You restudy the mistake. You don't brush it off. You address it like a serious athlete correcting form. This is how discipline becomes automatic. Step 4. The Prop Firm Challenge Simulation. Before you ever open an official evaluation again, you're going to complete a full prop firm challenge. But on demo, while following every rule you've practiced. You have one goal. Prove consistency under conditions that mirror the real thing. This simulation includes the real profit target, the real daily drawdown, the real max drawdown, the real time limit, the real break-even periods, the real pressure. But here's the twist. You're not allowed to adjust your system during the simulation. Traders often sabotage themselves by changing styles mid-challenge. Not this time. One system, one plan, one playbook, one challenge. Complete the simulation with full compliance, and now you're ready. If you fail the simulation, no shame. Just repeat it until you win with discipline, not luck. Step 5. The Funded Account Mindset. This is the final shift, and it's where everything changes. Passing the evaluation is not the goal. Getting funded is not the goal. Staying funded is the goal. The market doesn't care that you passed. The prop firm doesn't care that you passed. The only thing that matters now is risk management and longevity. Here's the mindset that separates traders who keep accounts from those who lose them in a week. You don't trade to hit targets, you trade to survive. Your job is not to make money. Your job is to protect your ability to make money. You become boring. Boring traders stay funded. Boring traders follow rules. Boring traders eat small wins, take small losses, and let the compounding do the work. You treat your funded account like a business. Your daily loss limit is overhead. Your max drawdown is risk capital. Your profits are cash flow. Your system is operations. If you draw down too much, the business closes. Your job is to stay in business. You never scale risk when emotional. Ever. Not when confident. Not when excited. Not when sure of a setup. Funding dies in emotional states. You always withdraw. Funded traders get paid. They don't chase bigger payouts. They take profits off the table to reward discipline. This is how you build a real trading career, not just pass a challenge. Step 6. The long-term identity shift. Once you complete the reset, the mental conditioning, the rule reinforcement, and the simulation, here's the final step. You stop identifying as someone trying to pass a prop firm challenge. You start identifying as a professional risk manager who earns money by executing a process with precision. When this identity takes hold, everything changes. Your discipline becomes natural. Your emotions calm down. Your FOMO dissolves. Your confidence grows. Your results stabilize. Because the truth is, funded traders aren't special. They're consistent. They're patient. They're predictable. They show up the same way every day, regardless of outcome. And now you will too. If you've made it through this entire series, you need to hear this. You are not far. You are not broken. You are not behind. You're just untrained. But now, finally, you have the blueprint. Not for hype. Not for quick wins. Not for lucky passes. For mastery. For discipline. For long-term success in prop firm trading. Now it's your turn. Not to think. Not to hope. To apply. Let's get to work.